It took just a single weekend to topple a 158-year-old institution. On Monday morning, September 15, 2008, the world awoke to the unthinkable. Lehman Brothers was gone. The fourth largest investment bank in the United States had declared bankruptcy, the largest in American history, with over $600 billion in assets and $619 billion in debt. Within hours, global markets were in shock. The Dow Jones plunged 500 points. Credit markets froze solid. What began as a housing slump had erupted into a worldwide financial near-death experience. But here's the truth: Lehman's downfall wasn't a black swan. It wasn't unexpected. It wasn't even surprising. It was the inevitable outcome of a system rewired for greed. A system where profits were privatized, risks were socialized, and reality was optional. Every empire collapses the same way, gradually, then suddenly. And Lehman's decline had begun long before 2008. Founded in 1850 in Montgomery, Alabama, by three German Jewish immigrant brothers, Henry, Emmanuel, and Meyer, Lehman started as a cotton trading company, financing farmers and linking the American South to Europe's textile mills. Over time, the firm expanded into financing, underwriting railroads, supporting manufacturing, and eventually powering the machinery of Wall Street capitalism. By the early 20th century, Lehman had endured the Civil War, 2 World Wars, and the Great Depression, helping fund industries that built modern America, from steel to retail to airlines. In the post-war years, it became a revered Wall Street name, cautious, discreet, family-run. But by the 1980s, the financial landscape shifted, and so did Lehman. The Reagan era introduced deregulation. The Glass-Steagall Act, which had separated traditional banking from high-risk speculation since the 1930s, was slowly dismantled. Debt wasn't avoided anymore, it was weaponized. Leverage became the gospel. Borrow cheaply, invest big, ride the upward tide. In this new era, Lehman transformed, not as a banker, but as a gambler. The firm bet on real estate, bonds, derivatives, and anything that could be packaged, priced, and sold. Wall Street had shifted from funding businesses that produced goods to creating financial products that produced money from money. By the early 2000s, this philosophy reached its peak in mortgage-backed securities. The idea seemed brilliant: bundle thousands of home loans into a single instrument, sell pieces to investors, and spread the risk. It was financial alchemy, turning debt into gold. Except the gold was fake. Banks were approving mortgages for anyone who could sign a form: no income, no employment verification, no problem. Risky loans were bundled, labeled AAA, and sold to pension funds and insurers as safe investments. It was a pyramid scheme dressed as innovation, and Lehman Brothers was one of its architects. By 2007, Lehman had become a real estate titan, holding over $600 billion in assets but only $22 billion in equity, a leverage ratio of nearly 30 to 1. For every dollar it owned, it borrowed 30. That wasn't investing, that was financial Russian roulette. Yet markets didn't care. Stocks rose, bonuses flowed, and the illusion of prosperity expanded. Wall Street no longer measured risk, it traded it. At the top of Lehman Brothers was Richard Dick Fuld. Cold, combative, and fiercely loyal to Lehman, Fuld valued domination over diplomacy. Under his leadership, risk soared, as did his personal fortune, $480 million earned between 2000 and 2008, even as the firm's foundation decayed beneath him. When analysts warned of the housing bubble's fragility, Fuld dismissed them. When Bear Stearns collapsed earlier that year, he insisted Lehman was different. When investors began fleeing, he blamed rumors and short sellers. But confidence couldn't change the math. The housing market was imploding, mortgage securities were losing value, and Lehman's debt exceeded its assets. Each hour wiped billions from its books. By September 2008, the U.S. government had already rescued Bear Stearns with J.P. Morgan Chase's help and quietly saved Fannie Mae and Freddie Mac. Lehman expected a similar lifeline, a bailout, a buyer, or both. But this time, Washington said no. Treasury Secretary Henry Paulson, a former Goldman Sachs CEO, declared the era of rescues over. No more bailouts, he told Congress, citing moral hazard, the idea that rescuing the reckless would only encourage more risk-taking. On Friday, September 12, government officials and bankers met at the New York Fed to broker a deal. Barclays showed interest, but British regulators wouldn't guarantee Lehman's massive losses. No other buyer emerged. By Sunday night, it was clear, Lehman Brothers would be allowed to fail. Paulson and Federal Reserve Chairman Ben Bernanke believed the system could withstand the shock. They were catastrophically wrong. At 1:45 a.m. on September 15, Lehman filed for bankruptcy, and the financial world convulsed. Within hours, the global credit system froze. Interbank lending, the plumbing that keeps money circulating, evaporated. Banks no longer trusted each other's balance sheets. Trillions in short-term loans vanished. Even solid companies struggled to roll over their debts. The panic spread globally. In London, trading floors emptied. In Tokyo, credit default swaps spiked. In Frankfurt, banks scrambled to cover U.S. exposure. Within a week, the world's largest economies watched the same red numbers plummet. But Lehman wasn't an anomaly, it was the blueprint. Every major investment bank had borrowed short-term funds to buy long-term, illiquid assets. When housing prices rose, wealth flowed. When they fell, leverage turned gains into landmines. Merrill Lynch was at 27-1, Morgan Stanley at 32-1. The system was a skyscraper of borrowed glass, and Lehman was the first window to shatter. As Lehman fell, so did the illusion of security. Investors fled to cash. Money market funds, once safe, began breaking the $1 peg. The public realized that nothing was truly stable. Governments tried to calm markets, but panic reigned behind closed doors. The Federal Reserve injected hundreds of billions in emergency liquidity, buying unwanted assets. And then came the hypocrisy. After letting Lehman die, the government bailed out everyone else. AIG received $182 billion, Goldman Sachs and Morgan Stanley gained bank holding status, and Citigroup and Bank of America were handed billions. While Lehman employees lost everything, Wall Street's elite got a blank check. It wasn't principle, it was power. Lehman didn't have the right allies, Goldman Sachs did. This decision turned a crisis into catastrophe. Trillions of dollars vanished, millions of jobs disappeared, over 10 million Americans lost their homes, and the global economy contracted by the size of Japan. Yet those responsible walked away wealthier. Dick Fuld, for instance, testified before Congress, blamed rumors and short sellers, and faced no charges. The U.S. government launched TARP, a $700 billion program to buy toxic assets, and the Federal Reserve quietly funneled over $16 trillion in emergency loans, including to foreign banks. The biggest wealth transfer in modern history, disguised as stability. Wall Street called it saving the system, but it was self-preservation. From that point on, central banks became the economy's life support. Interest rates dropped to zero, quantitative easing flooded markets with cheap money, and liquidity flowed into assets, not workers. Stocks doubled while wages stagnated. Billionaires grew richer while households sank deeper into debt. Lehman was meant to be a warning. Instead, it became the playbook. Every bailout encouraged more risk. Investors stopped asking, could this fail? And began asking, how large will the rescue be? Every bubble since 2008 followed the same rhythm. Tech crash? Fed cut rates. Housing crash? Money printed. Pandemic? Trillions in liquidity created overnight. Markets didn't just recover, they learned reality was optional. But this addiction to cheap money has consequences. The global economy now depends on debt like a patient on morphine. Each injection dulls pain but weakens the system. By 2020, global debt exceeded $280 trillion, 3 times the world's annual output. Leverage, speculation, and blind faith, patterns from 2008, are everywhere again, bigger than ever. Crypto promised freedom from banks, yet delivered chaos. Meme stocks became casinos. Tech valuations soared untethered from profit. Real estate boomed again, fueled by record low rates. Each time the system trembles, the solution is the same: print, borrow, inflate, repeat. Every rescue digs the next hole. Every bailout creates the next bubble. The illusion of control has replaced true stability. The financial system survives collapse only by spreading risk to everyone else. Banks fail. Nations default. But the machine keeps running. Lehman's legacy is the institutionalization of failure. We call it capitalism, but it's really risk socialism: profits for a few, losses for the public. That system reshapes politics. Money becomes infinite for the powerful, democracy negotiable. Lehman matters not as a company, but as a mirror, a demonstration of debt as destiny, and wealth measured by borrowing rather than building. 15 years later, the financial system is so leveraged and interconnected it can't be corrected without imploding. Central banks print, pause, raise, rescue, and the rest of us hold our breath. Every illusion of safety carries a countdown. The next collapse won't start with a bank run, it will start with a confidence run. Because money is trust, and trust, once broken, can't be bailed out. Lehman Brothers' fall wasn't just one firm's failure, it was the moment the mask slipped. We saw how fragile markets are, how democracy bends under financial panic, and how power exploits every crisis. The 2008 crash marked the shift from capitalism to simulation. Markets no longer measure reality, they manufacture it. Understanding Lehman isn't nostalgia, it's survival. Everything since has been built on that blueprint: credit addiction, illusory control, and the certainty that someone else will clean the mess. And that illusion, not subprime mortgages, not regulation, not arrogant CEOs, is the real bubble that remains. Lehman Brothers didn't merely collapse. It revealed how the system works, and who it truly serves. If this gave you a new perspective, hit subscribe.